Our next guest says the smart money is focusing on the Fed, not necessarily the pandemic or the Omicron variant. Let's welcome in Kevin Simpson, the founder and chief investment officer of Capital Wealth Planning, CWP. I mean, this is a great conversation to have you on, Kevin, because we want to know if this is a market that you still want to be buying into.
Well, filling in for Guy here for a few minutes is big shoes to fill, Dom. Thanks for having me. Like Jeff was saying, it's a market where you need profitability. So it's not a market to buy into, but there are stocks to buy into. And when I think about the theme for the day, I woke up this morning just wondering about the breathtaking beauty of science and how amazing it is. What used to take months, decades, years to achieve, we can now do in weeks, if not days. And right now, to your point, I think the markets are looking past the Omicron variant. They're looking past the next variant and the next one. And what we're focusing on more than anything else on Wall Street is next week's Fed meeting. What's going to happen with the Fed? Are we going to see an increase in the speed of the taper? Are we going to see interest rates? All of those things are going to happen, and they're all going to go back to Jeff's point, looking at quality stocks and looking at profitability for sure.
Hey, it's Tim. How are you? Welcome to the show. And look, we both actually run ETFs for Amplify. And one of the things you do is you find these high quality companies that pay decent dividends. Do you think in the world that we're going to be in next year with the Fed in play, totally agree that there's some sense that more Fed equals more volatility? I say this every day. And that the realm of vol we've had in the last couple of weeks may not be the norm, but 16 vol is also not the norm. What's the outlook for the div-paying stocks that you invest in, and the outlook for, again, these companies that are higher multiple companies and yet are defensive? That's the conundrum, because the companies you're talking about are companies that are trading really, in most cases, north of the 5-year range on their average PE.
Yeah, Tim, it's thinking about volatility. I was on Black Friday hoping to talk about, Black Friday sales and leftovers, and we saw the pre-market down over 1,000 points. Getting used to this volatility is something that's going to be the theme not only into the year end, but certainly into 22 and beyond. And to your point, when you're talking about valuations, it's something we really have to focus on. The only way these stocks can go higher, it's not going to be by multiple expansion, at least not the stocks that we want to invest in. The herd, the masses, they might look for the more speculative trade. Smart money, fast money crowd, you guys look at things differently. So valuations come into play. So if we're looking for these stocks that are a little bit stretched in multiples, if they're a little bit high in terms of their prices, we need them to be able to increase their earnings if we're going to have any hope of those stock prices appreciating. And even more deeply, Tim, like you said, I'm looking for dividend payers and dividend growers. If I want my stocks to continue to increase their dividends, I need to be darn sure that those earnings are going up and increasing to keep pace on those dividend growth names. So it's all about quality and profitability. I think it's a perfect theme for the day.
Hey, Kevin, Jeff Mills here. I just wanted to pivot a little bit to the Fed. Thinking about the faster taper, the writing seems to be on the wall there. Are you thinking about that as sort of a guaranteed quicker rate hike scenario, or are you looking at that as just preserving optionality for the potential to hike rates more quickly? Because I've been kicking around the idea that we get into the second half of next year, growth starts to slow a little bit, inflation starts to come down, the Fed almost finds itself backed into a corner. So just wondering how you're thinking about that over the next year or so.
Yeah, I can't give you that guarantee you're looking for, but I think that our thought process right now is we're going to see the increase in taper because it's easy. And the economy can handle it. We can handle a taper that they're going to double the pace of this pullback. That leads them to the ability to put interest rate increases at their fingertips. So my thesis has been that we'll see 2 rate hikes next year. And what if they accelerate it? What if there's 3? And we forecast even further into the future, and we say, okay, well, we've had 5 or 6 rate hikes coming off of a 0 base. That still puts us at a Fed fund rate of maybe 2.25, 2.5, 2 3/4, which from a relative standpoint, a historical standpoint, it's still practically free money. So we can handle it. I think the idea of them having this little bit hawkish tone to them is simply because of, to your point, this inflation running. We saw the CPI last month at a 30-year high. We're going to get a print on Friday that may even surpass that. But I'm thinking that's going to be like a capitulation point where we're going to be at its crescendo. And maybe they're transitory, even though they took the word out, that transitory thesis may hold true, at least a little bit. Maybe the supply chains continue to increase. Maybe inventories get better. Maybe inflation abates a little bit. But we can handle some inflation. We can handle higher interest rates. We just don't want really high interest rates and rampant inflation. So I think, Jeff, when we look at next year, to your point, we have to expect them to raise rates, and we can handle it. Wall Street doesn't want to see it, but the economy can handle it.
All right, so a lot to take in for sure, and I'm sure traders are handicapping it all in real time right now. Kevin Simpson, Capital Wealth, thank you very much. Please come back and see us again soon. We appreciate it. Let's trade it around, guys. Steve Grasso, I'll go to you with this one. Are there any particular trades, any particular companies, stocks, asset classes that stand out to you given what you think and what we just heard from Kevin?
Yeah, so the major takeaway is you want to be in the value basket. And along in that value basket, and I think Jeff had alluded to this earlier, there's a bunch of tech names that fit into that value bucket as well. So value versus growth, Apple is both. And the other names that I'm looking at, Trinseo, TSE, if value starts to rip, this is a stock that is buying back their own stock, selling off non-core assets. They're going to wind up buying back the company themselves. So this one can really rip off to the races. Another one, WestRock, WRK. This is a paper company, corrugated boxes. So if the economy is coming back, these value plays will rip. Those handful of value/growth tech names will rip as well.